Hey dough rollers, welcome back to the channel. Today we're talking about life insurance, and we're going to walk through a very simple method. It's called the DIME method to help you determine how much life insurance you really need. I've actually made a slight modification to the DIME method, and we'll talk about that. And then I want to cover a tactic that I think a lot of insurance agents use to get a lot of people to pay far more money than they should for life insurance. I'll cover that at the end of the video. So let's dive right in. So DIME is just an acronym. It stands for debt, income, mortgage, and education. And the idea behind the DIME method is that we can walk through each of these, and we'll do that, and kind of think through for each one of those categories, how much life insurance do we need? And then we just sort of add it all up, and we have, I think, a reasonably good idea of how much life insurance we should have. Now, I've converted DIME method to DIMES with an S at the end, and that stands for support, and I'll explain that as we walk through it. I think it's a very important part of calculating how much life insurance you need that the DIME method by itself misses. All right, so let me show you this on the screen. This is just happens to be from the John Hancock website, but you'll see here the DIME method, and you can find information about it on the internet from a large number of sources. This isn't specific to John Hancock. And so the idea is we're going to walk through each of these. Again, we're going to add an S at the end, but we're going to walk through each of these and think through, all right, do I need life insurance to cover each of these items? Now, keep in mind, for some of them, you may conclude, no, you don't need any life insurance at all. So let's start with the first one, debt. And so the idea here is if you were to pass away, or perhaps a significant other, do they have existing debts that would have to be paid out of the estate that you would like insurance to cover? For this first one, we exclude the mortgage. As you can see, we'll get to that in a minute. And so for a lot of people, I will say, I think the answer for a lot of people is that no, they don't actually need life insurance to cover non-mortgage debt. For example, you may have federal student loans, and they may be quite large, but the reality is if you were to die, those debts go away. If you die with a federal student loan, the federal government wipes out that debt. That's not something that we would need to insure. On the other hand, maybe you have a large personal loans, maybe you have a small business and you have some debt related to that business that you would like to be covered in the event that you die. And so if that's you, you know the amount of the debt, and you could include that in the total amount of life insurance you're going to buy. So that's the first one, existing non-mortgage debt. The second one is annual income, and a lot of folks will use sort of a rule of thumb of 10x income. So if you have income and you have other people, and this is important, you have other people relying on that income, as a general rule of thumb, you'll often hear, well, just multiply your income by 10, and that's sort of a good rough idea. I like to be a little more specific and think about a couple of other things. The first is, if you have young children, you might want enough insurance so that, say, your spouse or significant other or whoever's going to care for your children in the event of your passing doesn't have to work and can cover the expenses until they graduate from high school. And so if that's you, of course, how much you'll need will depend in large part on whether you're going to have more children and also, of course, the age of your children. But the other thing to keep in mind, and you'll want to confirm this, but with some exceptions, life insurance is generally not subject to income tax. Again, there are exceptions, so talk to your tax pro, your tax professional to make sure. But you keep that in mind. So if you have a salary of, let's say, $75,000, that's your gross income, but your take-home pay after taxes is, we'll just make up a number and say it's $60,000, you might be able to base your life insurance amount, whatever the multiple is going to be, on that after-tax income amount. Because again, life insurance typically, not always, but typically not subject to income tax. But I like to have a number that at least gets the children through high school. Now, you may want additional life insurance, say for your significant other, even beyond that. And so here's a strategy that you can think about. One, it involves two life insurance policies. So, for example, if you have young children, and let's just assume to get them through high school, you're gonna use we'll just say 18 times your salary. But you want additional income for your significant other for an additional 10 years after that. Well, you could effectively get two policies. Let's say for the 18X, you need $1 million. So you can buy a $1 million policy. Let's just say it's a 20-year term, close enough. And let's say after that, you want another, you want $250,000 beyond that for another 10 years. Well, you could get a second policy for $250,000 that would last 30 years. And so you'd have the larger policy until the children were out, say, out of high school, and then it would expire. But you'd still have this 30-year policy with another 10 years on it to cover that additional amount, whatever it might be. So again, as you're thinking through how much you need to replace your income, consider taxes. Also consider the possibility that you might want multiple policies that have different terms for each of them. One thing to stress here is that if you have absolutely no one relying on your income, you're single, you don't have any children, then you probably don't need life insurance to cover the loss of income should you pass away. Again, no one is relying on it. All right, so that's debts and income. And then, of course, we get to the M, and that's the mortgage balance. And a lot of folks, just think, an early death is a tragedy in and of itself. There's obviously a lot of pain for the family. It would just be easier if you didn't have the mortgage. And so you could add the amount of your mortgage to the total amount that you're going to insure. You could also just wrap it in and think about it in terms of just income replacement and use that to cover the mortgage payments. But a lot of folks would just prefer to say, look, if the worst case happens, I just want to pay off the mortgage, whatever that might be. And so you could add that mortgage debt to the total amount of life insurance that you want to buy. And then the third one for the dime method is education costs. So remember, with the income that we calculated, we get the kids through high school, but now maybe we want to also pay for their college education. And I suppose for that matter, you could even think about it in terms of high school education if you send your children maybe to an expensive private school. But I think for most folks, it's just college. And so you could, get an estimate of what, say a 4-year college is going to cost. And of course, depending on how many children you have, figure out what that amount is and add it to the total amount of insurance that you're going to purchase. And that's basically the dime method. And the basic idea is just to make sure we're thinking about all of the different areas in our life where we might need life insurance coverage. Now, I mentioned I add an S to it. And the reason I do that is because I think there's another thing that the dime method misses. And the S stands for support. So you may be a caregiver, you may be providing support. It could be for your children. That was our case. My wife decided to stay at home when our children were younger. And we had a small life insurance policy on her because if, God forbid something happened, I might need help raising the children, and that costs money. I think where it can really be important is if you're a caregiver, maybe you're taking care of a child with disabilities or perhaps an older adult, maybe a parent. And if something were to happen to you, there would be costs associated with taking care of that person. And so I think it's important to think not just about income in the dime method, but also support. If you're providing support for individuals, what the cost of that would be should you pass away. And I think if you walk through those, debt, income, mortgage, education, and the one I add, support, I think you're a good long ways to getting a clear picture of just how much life insurance you need. Now, I mentioned that there's an issue that I think comes up when you talk to insurance agents that I think is really important. In all of this discussion with the dime or dimes method, we're talking about term life insurance. You buy insurance, it for a certain amount, it lasts for a certain period of time, 10 years, 20 years, 30 years, and then it expires. But that's not the only type of insurance that's out there. There's also an entire category of what's called permanent life insurance. It's life insurance that never expires. Think of universal life or whole life are two examples of permanent life insurance. And at first that may seem like a great deal. I mean, why have it expire? Why not always have the protection of permanent life insurance? Well, the problem is, and this is what a lot of, I think, insurance agents don't tell you, is that as you might imagine, it's really, really expensive. It gets very expensive to insure someone for life. And so the premiums can get really, really out of hand. But here's the more fundamental thing. Almost nobody actually needs permanent life insurance. I've yet to meet someone in their 70s, 80s, or 90s who needed life insurance. They just don't. And that's true, by the way, even for very close friends that we have that have children with disabilities. They've managed to arrange for their care in ways that didn't require permanent life insurance. Now, could there be exceptions out there? Absolutely. I do think, particularly with parents with children with disabilities, there may be a case to argue for permanent life insurance. And if that's you, I would recommend that you talk to a financial advisor, and this is important, who's not actually selling you the insurance. I think that's the only way to get an unbiased view as to exactly what kind of insurance you need and what your other options are. But for the vast, vast majority of people, I think term life insurance is the best option. One of the places that I think is a good place to at least go get a quote is Haven Life. I'll leave a link to Haven Life below this video. So there you go. It's what I call the DIMES method. It's just a slight addition to the well-known DIME method. Hopefully that helps you out. And again, permanent life insurance for most people, no thank you. I just don't think people need life insurance later in life. Again, could be some exceptions, but for the vast majority of people, I think term life insurance is the best. Well, there you go. If you have any questions, leave them in the comments below. I'll be happy to help you out any way I can. And until next time, remember, the best thing money can buy is financial freedom.